Overall, I'm quite impressed with HIMS's performance in Q4 2023, but I'm slightly concerned about the company's negative reviews online. I'll be covering that more concerning aspect towards the end of the video, so stick around with me for that. For now, I'm going to start covering what I find most impressive and promising about a very important concept to have is that HIMS's moat will get much stronger as it deepens its personalization capabilities, since each additional degree of personalization makes the business exponentially more complex and satisfying for consumers. The company ended fiscal year 2023 with 30% of its revenue coming from personalized offerings, which is up from 15% a year ago. So this percentage has doubled in just a year. The company's recently launched healthcare categories are also seeing a much stronger shift from consumers towards personalization. 75% of Hers Dermatology subscribers are opting for personalized solutions, while all weight loss customers are opting in versus the 30% average. As these new categories scale, they are likely to act as a tailwind for personalization going forward. Personalization matters for healthcare customers because it increases convenience and improves outcomes, which ultimately leads to lower cost of acquisition and a higher lifetime value. In a nutshell, personalization improves unit economics. If personalization continues to advance at this pace, HIMS should have a far more defensible operation in a few years. And by the way, as I said in my deep dive, I believe the operation is already fairly defensible, compounded over a decade or two. This dynamic, coupled with increased scale, may materialize into an excellent business with perhaps insurmountable barriers of entry down the line. But this requires continued reinvestment. As I noted in my deep dive, HIMS management is highly focused on reinvesting cash into the business, and Q4 shows more compelling evidence in that direction. As the top line grows, management continues to increase the level of investment, with CapEx reaching new highs in Q4, and you can see this in the graph that I'm going to share in the screen now. Here we can very easily see how, as the top line has been growing quarter after quarter, so has CapEx. And by the way, the value for CapEx is negative because I'm extracting this from the cash flow statement in Seeking Alpha, but this is actually positive. So the amount that you see here in negative just means how much is the company reinvesting. And you can see that here in Q4, so December 2023, CapEx came in at an all-time high. Additionally, Q4 financials presented further compelling evidence of HIMS's focus on sharing economies of scale with customers. As HIMS gets more efficient by progressing with the previously mentioned dynamics of the continued reinvestment, it enhances its competitive position further by then lowering prices for consumers. In the graph that I'm going to show now on the screen, you will notice that ARPU, average revenue per user, has ticked down quarter over quarter due to HIMS reducing prices for consumers that opt into long-duration services. What is interesting is that simultaneously, gross margin is ticking up, coming in at 82.74% in Q4 versus a lower 82.62% in Q3. Check this out. In these two graphs, you can broadly appreciate how revenue per average subscriber has actually ticked down from the last quarter to this one, from $54 to $53. Nonetheless, the gross margin is actually going up. Here in the graph, that is not so easy to appreciate because they are rounding up the numbers. But as I was saying, in Q3, gross margin came in at 82.62%, and in Q4, it's up 82.74%. And it's not like the magnitude of the increase is impressive, but what is impressive is the trend, how average revenue per user is going down as HIMS is sharing economies of scale with consumers, and the gross margin is simultaneously ticking up. That is a very, very rare thing to see. So, in other words, HIMS's increased efficiency is more than offsetting price reductions. This sets the company on a path of giving consumers more for less, in a way that is increasingly harder to imitate at scale. Just the sort of business that can outperform over time. Now, here's something that perhaps I didn't like as much, which is essentially that in Q3, management said that in Q4, all orders would be processed via proprietary pharmacies. But the company has seemingly come short of this target. So Andrew Durham said in Q3 2023 the following: nearly 80% of orders in the third quarter were filled through our affiliated pharmacies, And it is our expectation that nearly all orders will be fulfilled via affiliated pharmacies by year end. So when I say proprietary pharmacies and they say affiliated, we're just referring to the same thing. These are pharmacies that Hims owns. In the Q&A section of the call, an analyst asked management to clarify, and CFO Yemi Okupe explained that the company now intends to maintain the share of orders going through third-party pharmacies, so the pharmacies that Hims doesn't own, in the high single-digit to low double-digit levels for redundancy purposes. When management says nearly all orders and above 85%, there is indeed quite a bit of margin for interpretation, but it is strange that management did not disclose in Q3 that they intended to pursue this configuration. This can perhaps be seen as a communication error, because as explored in the previous section, the company is definitely getting much sharper. In the financials, there are no signs of dysfunction as it refers to Hims' deployment of proprietary pharmacies. So even with this little, perhaps, communication error, I think I'm not too concerned. On top of the rapidly increasing efficiency, which I really like, OPEX is now getting leaner as the company's bottom line continues to converge upwards. However, as I will explain now, and this goes back to the concern that I was talking about at the beginning of this video, this may be negatively impacting culture. In Q4, the quarter-over-quarter delta of the operating margin is larger than that of the gross margin, which are up 4.83% and 0.12% respectively. So operating margin is up nearly 5% quarter over quarter, and this is a very impressive increase. Naturally, the lower prices for longer duration customers dampen, quote unquote, gross margin growth. But the point is, Hims is getting operationally leaner too, as well as more efficient. Marketing costs as a percentage of revenue improved 1 point. Operations and support costs as a percentage of revenue improved 1 point. And G&A costs as a percentage of revenue improved 3 points. As a result of this leverage, Hims' bottom line is converging upwards, with Q4 being the first quarter of positive net income in the company's history. Check out this graph. Here we can see how the bottom line, so Hims' net income, is converging upwards. And this is the first quarter in the company's history of positive net income. In my recent deep dive of the company, however, I explain why focusing on profitability is the wrong way of analyzing Hims' financials. A company that prints cash from operations and that has a negative net income does not actually lose money. The best growth companies focus on increasing free cash flow per share over time and not exactly net income. Nonetheless, it is excellent to see that Hims has the ability to gain leverage on its OPEX buckets as it gives customers more for less higher up in the income statement. Over time, this will increase free cash flow yield as Hims continues to compound efficiency at the gross margin level. Here's a quote from Yemi Okupe, the CFO during Q3, which I think is interesting and speaks to how they view this process of getting more efficient. He said, "Leveraging scale and actively capturing efficiencies is a core trait that extends beyond operations and is embedded in the DNA of Hims and hers." That is definitely the sort of thing that I want to hear. However, management does not disclose the source of this increase in operating leverage. Having reviewed the company's ratings on Glassdoor, there seems to simultaneously be some degree of internal discomfort among employees. The declining curve that you see in the graph on the screen now coincides with the decreasing OPEX as a percentage of revenue, which has come down since the high of 124.6% at the end of fiscal year 2020. Most of the negative comments on Glassdoor allude to a management team that does not reward employees that are highly committed to the business. In turn, it seems that most of the negative reviews come from employees in the customer service domain, while most of the positive ones come from seemingly higher skill positions, such as engineers. Similarly, most of the bad reviews on the customer end allude to poor customer service, which makes me think that perhaps that part of the operation has been somewhat stretched by the fast growth. My concern is nonetheless that this may be indicative of a generally declining or toxic culture. However, my fundamental observation is that a company with a toxic culture, or at least one that is undesirable for long-term value creation, cannot do what Hims does. Creating an enterprise of this complexity and getting it to print cash from operations, which is the result of a long sequence of impossible feats, that I discussed in my deep dive, which by the way is my previous video, requires by default a high performing organization. By the way, here's a graph that depicts the company's cash from operations over time, and we can see how clearly Q4 2022 was an inflection point, and ever since the company has just been printing cash. There's been a slight decline this quarter, but perhaps nothing that actually reverses the trend. I think this company is going to be printing more cash. And as I would explain later, I believe that this trend will be accentuated by personalization. Now, going back to the idea of bad reviews, in a tweet in which I linked to in the written form of the update, which you can find in my blog on Substack, Andrew Durham said that he is currently, quote unquote, all over this issue, and it will be very interesting to see if he/they can resolve it. I suspect that the same organizational properties that have allowed the iOS app to rank number 16 in the US App Store just the year after its launch will also enable them to fix this problem. So I think that their DNA, HIMS's DNA, is quite optimal when it comes to solving problems. And I think that if I had to bet money now, I think they will probably solve it. But I will be definitely keeping an eye on this development. Now, moving on to the financials, on top of the financial aspects that I've already discussed, such as the increased efficiency and operating leverage, HIMS's balance sheet is getting stronger. HIMS ended Q4 with $221 million of cash and short-term investments, which is up a rather impressive $41 million from the end of 2022, and the company has no debt. With personalization increasing, I believe HIMS's ability to produce cash will be strengthened going forward. Together with the simultaneously rising efficiency and leanness, HIMS's balance sheet should also get stronger over time. And what's actually very important, and I don't think I mentioned this in my deep dive, is to understand that HIMS solves a big pain for its customers that suffer stigmatized conditions. The underlying driver of the balance sheet's fortitude is actually the gradually increasing breadth, convenience, and price competitiveness of HIMS's service. And so long as HIMS continues to advance quarterly on these three differentiating pillars at scale, I believe the company will have more cash to reinvest over time. And definitely, so far, I am really impressed with the way that the company has progressed in these three pillars. Now, to conclude the update, I am most concerned about the negative employee reviews on the company. I certainly do not want to invest in a company with a toxic culture for the long term. However, all other aspects of the company point to a high-performing organization. In July 2021, for instance, the reviews on Glassdoor were much more pertinent of a company with the level of performance that HIMS has exhibited to date. Here you can see what that looked like. Here's Andrew Durham looking all happy-clappy, 100% approval of the CEO, and 90% would have recommended at the time to work in HIMS. But of course, this was only made out of 18 ratings. So the truth is that, and regardless, I think, although the reviews at the time consist of a small sample, the latest negative reviews are not a large sample either. And as mentioned, they mostly come from employees in the customer service side. So I guess that these data points need to be weighed accordingly. Since fiscal year 2021, the company has grown its top line by 3.2x and has cut its OPEX from 114% of revenue to 84.97%. My main takeaway from the call, apart from the increased efficiency and operating leanness, which I love, is that I wouldn't be surprised if these two trends, so the rapid top-line growth and the leaner operations, have indeed caused some sort of a customer service bottleneck, or indeed lead to some sort of a very high-pressure environment in which not everyone is comfortable working. But the truth is that the company is doing great. I'm very impressed with the performance this quarter. And if the company continues to progress like this over the years, I think this can be a very big business down the line. And especially for the macro drivers that I talked about in the deep dive. The US healthcare industry is a highly inflationary, dysfunctional one. And HIMS seems like a beacon of coherence, customer centricity, and is definitely engaged in a deflationary path, which I think customers love. So I continue to evaluate a potential long-term investment in the company, and I'll keep you updated on that. So until next time, and thank you very much for joining me. Have a nice day.